When it comes to markets, what we see is that, much of this strong growth and need for tighter monetary policy is largely priced in to a number of financial markets. Equity prices have reached, are basically at highs. Expectations of Fed cuts have gone from 6 to 7 cuts expected to kick off the year now to roughly 1 to 2. Those two markets basically are reflecting the strength of the economy, the inflationary pressures, and the need to maintain tight money for an extended period of time. The main place that's not reflecting that is in the term structure of interest rates, which, if you were to, there's a lot of different ways to measure the term structure of interest rates and the term premium. Uh, and, you put a bunch of academics in the room and they'll all have their own opinion about it. Um, it doesn't matter so much exactly how you measure it and what the precise number is. What matters more is to kind of get a sense as to what does that term premium, that rough term premium look like relative to what it's been, say, for the last 10 years? And how does that compare to how economic conditions look relative to the same period? So, as a simple example, if you take a look at this measure of term premium, what you see is that, the current term premium in the bond market, 10-year bond market, is roughly consistent with the average that it's been over the course of the last 10 years, 10 or 15 years. And that's pretty notable considering the fact that uh, if you look at the economic conditions right now, they're certainly considerably more elevated relative to how they've been on average over the last 10 years. If you look at inflation pressures, they're certainly more elevated relative to what they've been in the last 10 years. And if you look at overall tightness of financial conditions, the short rate has been very elevated relative to what it's been the last 10 years. And so you sort of put all these different pictures together. The need for tighter monetary policy for an extended period of time is certainly unusual relative to the last 10 years. And so, stronger growth, higher inflation, and need for tighter structural monetary policy, you put all those things together. And the idea that you have essentially the same term premium in place that you did over the last 10 years, it doesn't quite add up in terms of how the long end is priced. That's occurring at a time when we're likely to see the long end supply continue. The last time we talked, there was real questions about exactly what policy would be announced in the QRA. And the reality is, what we got was just basically more of the same. And if you look here on the left hand side, what you see is a chart of the total amount of notes and bonds that are being issued over the course of the next 6 months or so. And what you see here is that that level of issuance is going to continue to be significantly elevated, not quite higher than in history, but nonetheless, it's going to remain considerably elevated. And as a function of that, you'll have continued pressure on the bond market as that supply continues to flow through. That supply, if anything, is worse than what it's been in a fair amount of the post COVID period, because at least back when we had that big supply around COVID, you had a situation where there was significant bond buying by the Federal Reserve, whereas at this point, quantitative tightening continues to create a drag on the bond, an ongoing flow and drag on the bond market. And when you think about that basic story, what ends up happening is that will, in one way, shape, or form, that's essentially the selling of bonds, is essentially an ongoing negative flow of capital, negative flow in terms of asset prices, as it represents a continued flow or sale of asset prices on an ongoing basis. And so the thing I think is pretty interesting is how asset prices are currently transpiring relative to where we've been over the course of the last couple of years. And what you see there is with that measure of RPAR, basically asset prices have remained constant, still near highs. Relative to the last couple of years, they fell as the bond supply question came into existence sort of late last fall. But by and large, asset prices have recovered what happened last fall, and they remain basically at peaks. Now, that's particularly notable because what it means is that such strong asset prices combined with this significant flow of supply, really raises a question about whether we're going to continue to see such strong asset prices ahead. The bond supply is going to affect all asset prices in one way, shape, or form. Continuing on, I think what that really highlights to me is that um, the thing that's going on, in terms of the cross asset markets, is that the bond market really is in control. The bond market, uh, I think there was a period of time when we were coming into the year where expectations of U.S. economic outcomes were quite different than what was likely to transpire. So coming into the year, what we saw was that expectations of U.S. growth in 2024 were going to be about 1% or lower. But then what happened? What shifted to kick off the year was a big shift in those expectations, particularly in the U.S. stock market, where today U.S. stocks are now expected to have earnings growth at something like 17% by the end of the year on a year-over-year basis, and economists' estimates of economic growth in the U.S. are for U.S. Economic real GDP to be about 2.5% over the course of the entirety of 2024. 2.5% GDP in this economy is pretty strong GDP, all things considered. And so what you see here is a picture that sort of got priced in. That repricing of the strength of economic conditions got priced in. We saw stocks basically move to new highs. We saw bond yields move up, somewhat in response to that. But now we've transitioned to a different point in the cycle where what's happening instead is that expectations of strong growth already exist in the market and continue to remain in place. So, what creates the incremental shift in terms of asset prices is not those expectations because they're still firmly in place. What creates the shift in prices is now the discount rate, and we see this everywhere across assets. So we see in the U.S. stock market basically trading highly correlated to the U.S. bond market in the last couple of weeks. We see foreign bond markets trading tightly to what's going on in the U.S. bond market. We see the yen trading closely connected to what's going on in the U.S. bond market, and we also see assets as extreme as what's going on with Bitcoin trading closely to what's going on in the U.S. bond market. And so all of those things are indications, and that bond market connection created a sell-off in asset prices in April, and then created a rally here to kick off the month of May as bond yields started to come down. And so I think a lot of folks are focused on what's going on with, say, earnings or other dynamics in the market, but what's really driving the moves in asset prices are what's happening with the long end. So the long end is really in control and in control globally.